Welcome back to our Legacy Builder series. I'm Lisa Ward, the founder and CEO of Plumb Financial. So what are two things guaranteed in life? Any guesses? Taxes and death. We won't talk about dying today, but we will talk about taxes. Those pesky taxes. So understanding how you are taxed on all of your different assets and managing that in retirement and for legacy purposes is vital to achieving your goals. So let's kind of run down the different ways assets can be taxed. So we have our traditional IRAs. So that is tax deferred. It was taken out of our payroll while we were working before we paid taxes on it. It grows over time, and when you take money out, then you pay taxes on it. Okay? So it's tax deferred. We'll pay on it later. Well, what if we've done a Roth IRA? Then we have already paid on the taxes or done a Roth conversion and paid on it. It grows over time, and when we take money out, then it's tax-free. Well, there might be a in-between before tax deferred and tax free. There might be a brokerage account where you potentially have gains. We've got short-term gains. If we bought and sold something for a profit, that is going to be at our regular income rates as if it was regular earned income. But if we held a position for longer than a year, then that is long-term capital gains. And based on your income for the year and what the household looks like, you've got different tax rates on the long-term gains, or might not even have taxes on the long-term gains. So it kind of depends on what you look like on paper. It could be short-term gains or long-term gains. And the market's been doing really well. So how do we mitigate or lock in some of these gains? We've got, say a stock that has appreciated in value and it's now a much larger percentage of your overall portfolio, and we need to sell off, lock in some of those gains, but now we've created a taxable event. So then we look through the portfolio and go, well, this one, it's gone down in value and it's not looking great. We might want to sell that for a loss. And long-term gains and long-term losses can net one another out so that we can not pay a tax. Like, Lisa, what? That doesn't make sense. No, that's exactly what tax loss harvesting is. Ongoing tax management, looking at a portfolio of individual stocks and individual bonds throughout the year. And if a certain stock has done really well, the value has gone up, and we don't want that much of our portfolio tied to that allocation anymore, or we want to lock in that gain, we can sell off part of that position and then go back through that list and look for some stocks that they're not performing well, something has changed within that industry, or that company just didn't meet their earnings goals and we want to sell that for a loss and net those out. That is an opportunity, and that is what we do at Plumb Financial for all of our brokerage accounts. So if you don't have that ongoing tax management in your brokerage accounts, now is the time to talk. We need to review that and see why. Why do we not have that where we currently are? And let me show you what it would look like if we transitioned your portfolio over to us and use a tax management strategy transitioning that over to us But you should have tax management a part of your overall wealth portfolio, wealth management, so that when things do happen, say we have a home repair and we need to take out a larger withdrawal from one of the portfolios, well, that is a strategy that we use with our households. Where do we strategically take that out so that we're not creating a large taxable event? Or say we're still working and we've got this massive bonus at the end of the year. How do we help mitigate that with everything else we've got going on with our wealth accumulation? So tax management is ongoing. We work with your CPAs and your accountants to make sure we are doing what is in your best interest so that we pay hopefully as little as possible. Now, if we've got gains and we're making money, taxes are inevitable. We can't get it to completely zero, but we can use some strategies to reduce where we can. So end of the year, we're looking at, planning for 2025 tax return. Is there anything else that we can do at this point? Please let me know. Let's schedule your blueprint call and let's talk about taxes.